We're jumping straight into BitMine Immersion Technologies today. Everyone is watching the price action, but the real story is the massive $200 million stake in Beast Industries and their relentless Ethereum accumulation.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the billions, I mean literally billions of dollars we have to talk about today, do us a quick favor. If you want to stay ahead of these massive market shifts, hit that subscribe button and smash the like. It really helps us keep the insights coming straight to you.
It does.
Now let's unpack this, because the numbers here are frankly staggering.
They are. And you know, if you're just reading the ticker tape or glancing at a headline on your phone, you are missing the forest for the trees. To understand why BitMine is suddenly the most talked about stock on the street, you have to realize we aren't talking about a Bitcoin miner anymore.
Right.
That label is just obsolete.
It feels a bit like calling Amazon a bookseller in 2002, doesn't it?
That's a great way to put it.
The core business has fundamentally mutated. We are looking at a company that has effectively pivoted to become a crypto treasury company.
Yeah.
But here is the twist, and this is what distinguishes them from everyone else in the sector. The crown jewel isn't Bitcoin. It's Ethereum.
That's the critical differentiator. While the rest of the industry was looking, chasing Bitcoin hash rate and trying to squeeze margins out of hardware, BitMine looked left. They've accumulated a war chest that is just difficult to wrap your head around. I mean, let's look at the hard data from their latest disclosures.
Okay.
BitMine currently holds, get this, 4.168 million Ethereum tokens.
Wow. 4 million. Even for people deep in crypto, that scale is just hard to visualize.
Think of it this way. That is roughly $13 billion in Ether sitting on their balance sheet.
13 billion.
And they aren't cash poor either. They have nearly $1 billion in cash on hand. So total liquid assets, you're looking at $14 billion.
Okay, to put that in perspective, because we always try to give you the summary here, that represents approximately 3.45% of the total circulating supply of Ethereum.
Yes.
One single company holding nearly 3.5% of the entire network's currency.
They are the largest fresh money buyer of Ethereum in the world right now. No one else is even close.
It's the MicroStrategy of ETH argument, right? That's what the analysts are whispering.
It is.
But MicroStrategy buys Bitcoin digital gold. BitMine is buying Ethereum. For the listener who might not be a crypto native, why does that distinction matter? Why bet the farm on ETH instead of BTC?
Well, it comes down to utility versus store of value. Bitcoin is digital gold. It sort of sits in a vault. It's valuable because it's scarce.
Right.
Ethereum it's the programmable layer of the internet. It's the oil that powers the machine. By hoarding Ethereum, BitMine isn't just betting on a price increase. They're betting on the usage of the entire decentralized web.
So they're betting on DeFi, NFTs, stablecoin.
Everything. Everything that wins on that rail.
So they aren't just buying the asset. They're buying the infrastructure.
Precisely. But here is where it gets fascinating and where the beast comes in. Because if you just hoard coins, you're just a vault.
Right.
BitMine wants to be an engine.
This is the part that broke the internet yesterday. The headline. BitMine dropping $200 million into Beast Industries. And for anyone living under a rock, that is the business empire of MrBeast, the biggest content creator on the planet.
It definitely caught the market off guard. I mean, on the surface, a crypto mining firm buying into a YouTuber's business. It sounds like a vanity project.
Yeah.
It sounds like something a CEO does when they're bored and have too much cash.
I'll admit, when I first saw the notification, I laughed. It seemed absurd.
Yeah.
But when you peel back the layers and, look at the strategic notes, you start to see the moat they are trying to dig.
It's about customer acquisition cost, or CAC. In the financial world, particularly in fintech and crypto, getting a new customer to use your product is incredibly expensive. Banks spend hundreds of dollars in advertising just to get you to open a checking account.
Right. You think about all the marketing budgets, the Super Bowl ads, the sign-up bonuses. It just burns cash.
Exactly. Now look at Beast Industries. They have an audience of over 450 million subscribers across all channels.
It's huge.
That is a distribution network larger than the population of the United States. And more importantly, it's an audience that trusts the creator.
So the synergy isn't just cool videos. It's about weaponizing that audience for distribution.
Correct. Imagine the network effect. BitMine has this massive high-performance computing power and deep DeFi decentralized finance capabilities. If they launch a consumer-facing product,
Like a payment rail or a crypto wallet.
right, or a yield product, they don't have to spend millions on ads. They just plug it into the Beast ecosystem.
They bypass the traditional marketing funnel entirely.
100%.
A traditional miner plugs a machine into a wall and hopes the price of crypto goes up. BitMine is trying to combine financial infrastructure with the massive distribution of the creator economy.
It creates a competitive moat that generic miners just can't replicate. You can buy more mining rigs, you can buy more land, but you can't buy MrBeast's audience overnight. That takes a decade to build.
It's instant global distribution. And that is something Wall Street is clearly waking up to. Because it's not just retail investors chasing the hype here. We are seeing what the research notes are calling institutional cluster buying.
This is a crucial validation point. Usually when a company does something this weird, mixing crypto and YouTube, institutions run for the hills.
They hate it.
They hate uncertainty. They hate things that don't fit in a neat box. But that's not happening here.
So who is buying? Because that tells us a lot about the why.
The list is substantial. We saw Sumitomo Mitsui Trust drop $196.5 million. That is 3.7 million shares in a single sweep.
Sumitomo, that's conservative, old-school Japanese money. They aren't usually chasing memes or high-risk tech plays.
That's exactly my point. If it was just a hedge fund, maybe you'd shrug. But Sumitomo. Then you have Robeco, Nations Financial, Thames Capital all entering the fray.
Okay.
Why? They aren't buying because they like MrBeast's challenges. They are buying because they view BitMine as a proxy.
A proxy for Ethereum exposure.
Exactly. Many of these funds have strict mandates. They can't just go to a crypto exchange and buy Ethereum tokens. They can't deal with the custody issues, the security keys, the regulatory headaches.
It's too messy.
It's too messy for their compliance departments. But they can buy a stock.
So BitMine becomes the wrapper. It's a safer way for them to play ETH than buying the token directly. You get the upside of the crypto plus the operational business backed by a fortress balance sheet.
You get the exposure without the operational risk of holding the keys yourself. That's the smart money thesis. But there is one more catalyst on the bull side that we can't ignore, and this one is a bit more technical, but potentially massive for their cash flow.
Okay.
The Maven network.
The Made in America Validator Network. This is launching in Q1 of this year, 2026.
Yeah.
Break this down for us. Why is a validator network such a big deal for the bottom line?
It solves the lazy capital problem. Right now, holding $13 billion in Ethereum is great if the price goes up, but it's a passive asset. It just sits there on the ledger.
Like gold bars in a vault. They don't pay dividends. You just hope someone pays you more for them later.
Right. But Ethereum is different. If you stake it, meaning you use your ETH to help secure the network and process transactions, you earn a yield. It's essentially interest paid by the network protocol itself.
So Maven turns that $13 billion pile of Ethereum from a passive asset into an active revenue generator.
It transforms the business model completely. They aren't just hoping for price appreciation. They are generating cash flow from the asset itself.
Wow.
Analysts are looking at this as a sovereign-grade yield generator. Even a small percentage yield on $13 billion is massive revenue.
And the Made in America part, is that just branding? Or?
Yeah, it's actually strategic. There's a growing demand for regulatory compliant, geographically localized staking. Institutions like those Japanese banks we mentioned might feel safer staking their ETH with a US-based compliant network rather than a decentralized pool run by anonymous developers offshore.
It adds a layer of institutional trust.
It does.
Okay, so sum up the bull case. We have a $14 billion treasury, a tie-up with the world's biggest creator for distribution, and a plan to generate yield on all that crypto. It sounds perfect.
It sounds almost too perfect.
And that is usually when you need to start asking the hard questions. Because I'm looking at this stock chart, and it's vertical. But trees don't grow to the sky.
No, they don't. And there are massive risks here that we need to play the skeptic on. We have to look at the other side of the trade.
Let's pivot to the bear case. What is the catch?
Yeah.
Is it just that the price of ETH could go down?
That's the obvious one. But let's look at the mechanics of leverage. The market treats BitMine as a leveraged play on ETH. If Ethereum drops 30%, which, let's be honest, in crypto is a bad Tuesday, right, billions of dollars are wiped off their book value instantly.
Unlike a regular tech company that might have a bad quarter but still has its factory and its patents, BitMine's primary asset is the volatile thing.
Precisely. Their solvency and their valuation are inextricably linked to a number they cannot control. If we enter a crypto winter, BitMine doesn't just lose revenue, they lose their asset base. They could go from genius visionaries to holding a bag of depreciating assets very, very quickly. But there's a bigger, more structural risk that jumped out at me in the meeting notes.
The 50 billion share question. I saw this in the charter amendment filings.
We have to talk about this. This was the context around the January 15th meeting. The company sought to increase its authorized shares from 500 million to 50 billion.
Whoa, hang on. 50 billion. That is a lot of zeros. That's a 100x increase in authorized shares.
It's a massive jump, and for an existing shareholder, that number screams one terrifying word: dilution.
Let's explain this simply for everyone. If I own a slice of the pizza, and the chef suddenly cuts the rest of the pizza into 50 billion tiny slices to sell, my slice doesn't get smaller physically, but it represents a much smaller percentage of the whole company.
Exactly. Here is the mechanism. To keep up this relentless buying pace, to keep being the largest fresh money buyer, they need cash.
Right.
They don't generate enough cash from operations to buy billions in ETH, so they get that cash by selling stock.
It's the at-the-market offering strategy. They print shares, sell them to the public, take the cash, and buy Ethereum.
Which works great when the stock price is high, but it's a race against the printing press. If they sell stock faster than the value of the Ethereum goes up, the existing shareholders get diluted.
So you're betting that the Ethereum they buy with your money will appreciate faster than the value you lose by them printing more shares.
That is a high wire act. If the stock price slips, or if ETH slips, that spiral can get ugly fast. It creates a feedback loop.
Okay, and what about the actual business operations? You mentioned earlier that the mining label is obsolete, but they still report earnings. The numbers looked a bit messy.
Yeah, I was looking at the last earnings print. Revenue missed expectations, but EPS beat?
How does that happen? How do you miss on revenue, but beat on earnings? That sounds like accounting magic.
It's a complex accounting story specific to how crypto assets are marked on the books. The swings in asset value can distort the earnings picture significantly. But fundamentally, if you strip away the crypto gains and look at the core operations, they have negative net margins.
So they are losing money on the actual day-to-day business of mining.
In some contexts, yes, or at least the margins are razor thin compared to the massive swings in their treasury. This creates a disconnect. If you are a value investor looking at PE ratios or operating cash flow, you are going to hate this stock.
Right.
It doesn't make sense in a traditional framework.
It's an asset play, not a profit play. You aren't buying it for the quarterly dividend from mining operations.
Correct. And then there's the execution risk we touched on. Integrating beast industries.
Yeah, going back to that, it sounds cool in a pitch deck, but running a crypto treasury and running an entertainment partnership are two very different skill sets.
That is the risk of style drift. Are they losing focus? They are experts in immersion cooling and high-performance computing. Do they know how to leverage a YouTuber's audience effectively?
Just because you have the ingredients doesn't mean you know how to cook the meal.
Exactly. And relying on a third party, even one as successful as MrBeast, introduces variables outside their control. If the creator economy shifts, or if that brand takes a hit, BitMine's investment takes a hit too. $200 million is a lot of money to bet on a maybe.
And let's be real, creator life cycles are notoriously unpredictable. Basing a corporate strategy on an influencer, even the biggest one, is a brave move.
It is. So we have a clear picture now. On one side, a massive, unmatchable treasury and a potential game-changing partnership. On the other, extreme leverage, dilution risk, and a confusing operational picture.
A classic high-risk, high-reward scenario. So for everyone listening who is trying to figure out what to do now, let's look at the next 30 days. What are the key things to watch?
First, keep an eye on the price target. The sources indicate analysts are currently eyeing a target of about $43.
And with the stock trading in that $30 to $32 range recently, that implies some serious upside.
It does, but that target is contingent on execution. Which brings us to the second point, the aftermath of the Beast deal.
The deal closed around January 19th, so basically yesterday. The ink is dry.
Right. Now we need to see the roadmap, watch for official press releases. We need to see how they're going to integrate these treasury strategies with the Beast brand.
Is it a specialized wallet? A content series on DeFi?
The market will want specifics, not just headlines. If they stay silent for too long, that style drift fear might start to creep in.
Investors hate silence after a big check is written.
Exactly. And then, of course, the MAN launch. We are in Q1 2026. The market is waiting for a specific launch date.
We need to see the Made in America Validator Network go live. If that gets delayed to Q2 or Q3.
That hurts the yield narrative. The whole active revenue argument relies on those validators turning on. Any delay there will be punished by the market because it implies technical hurdles or, regulatory pushback.
And finally, the obvious one.
Ethereum performance. You cannot decouple BitMine from ETH. If Ethereum rallies, BitMine re-rates higher. If Ethereum slumps, BitMine feels the pain.
It is the tide that lifts or sinks this ship.
No question.
So if you're watching BitMine, you're really watching a leveraged bet on the future of Ethereum with a side of pop culture.
That is the reality. It's a derivative trade on the crypto market itself.
Okay, let's wrap this up with something to chew on. We've talked about mining, we've talked about YouTube, we've talked about treasuries. But when I look at $14 billion in liquid crypto assets, are we even looking at a company anymore?
What do you mean?
I mean, look at the scale. Are we looking at a mining company, or are we looking at the future of banking? Think about it. With that much capital and a direct tie-up with the world's biggest creator for distribution, BitMine might be building the first central bank of the internet economy.
It's a provocative thought.
They have the reserves, that's the ETH. They have the network, that's the blockchain. And now they have the people, that's Beast. It feels like the lines between corporate finance and sovereign wealth are starting to blur.
It's certainly possible. We are seeing these massive pools of capital act almost like nation-states in the digital realm. Whether they can pull it off without collapsing under the weight of their own leverage, that's the billion-dollar question.
And that is the lowdown on BitMine Immersion Technologies. A massive bet, a massive hoard, and a massive question mark on what comes next.
If you enjoyed breaking this down with us, make sure you're subscribed. There is always another move in the market, and we'll be here to simplify it for you.
Thanks for listening to the Easy Money Show. We'll catch you on the next one.